Hello and welcome to lesson 5 of the course. And in today's lesson, we're going to be going through getting your money right. So a lot of times businesses have cash flow forecasts, or they don't have forecasts, they have cash flow problems because they don't have the forecasts. Perhaps they've got a lot of transactions that are occurring. Maybe the invoice gets sent out late, it gets paid late. Then they don't reconcile it for a very long time. And then what happens is because they've not reconciled it, now the reports are in delay, so it's probably not until a month, 2 months, maybe even 3 months later when they actually understand the cash flow position and the performance of their business. So information is a problem in most businesses, whether or not they understand where they're at. And this can go both ways. Not only does it show you a bad performing company long after the fact that it's been poorly performing for a long time, and now it's kind of too late to do anything to fix it. It can also go the other way. Maybe you've had some success and it's not really clear immediately, but you're getting more profitability. You could be doing some excellent things for a little while and go through a burst of profit, and then it drops off for whatever reason. But it's really hard to attribute that this activity caused that result if there's such a long delay between when you do the activity and when you get the reporting. A lot of times I also see businesses getting the wrong terminology. Now, I know terminology is normally not really a big deal. It's kind of like semantics and just words. But in accounting, it's actually very important because if you can talk about the same thing with the people around you, then it makes sense. I once heard someone say the word profit when they were really referring to revenue. Now, the reason why this is a problem is because you could be making $1 million, but you can also be making $1 million cost. Or if you sell something for $1 and it costs you $2 to make, then using the word profit is very much the wrong way to go about it. So there's a couple of ways to break down the term profit as well. So not only revenue, which is your total number. So I sold 10 things for $10. Therefore, my total revenue is $100. But then from that, there are two kinds of profit numbers. So one is your gross profit. So if I sold an item for $10 and it cost me $5 to make, as in the total goods of the product itself, then my gross profit is $5. Now, that is the budget that I then have to apply to all my operational expenses. After I've calculated all my operational expenses, wages, storage costs, rent, light, power, heating, etc., then I have my net profit. Then you can also break that down further to be net profit after tax, because you should definitely be considering how much money you've made after the tax man gets their cut. And sometimes profit that shows on the balance sheet or on the profit and loss is not actually the profit, because maybe there are some expenses that have not really come out of that yet. So cash and profit are two separate ideas. So cash is the money that you have in your bank account, the resource that you can deploy right now. But profit may be different because tax doesn't show up as cash. It doesn't show up as a cost on the profit and loss until you have paid it out later. You might also be taking director's fees that are not being calculated as profit. They will be once your accountant does the tax finalization at the end of the year. But in the short term, you might have an excellent looking profit and loss just because a few other numbers haven't been processed yet. So you really need to get clear on what your numbers are, what your numbers are not, and to be really crystal clear on the terminology, because that is going to be how you interact with the other financial specialists that work in your business. It could be an internal admin, it could be a bookkeeper, or it could be an accountant or advisor. Now, you also need to be aware of calculations when you're trying to work out how much money you need to make to have a viable business. Not only do you have to have a gross profit, your gross profit has to be enough to cover your operating expenses, and then you still need to have enough at the end of that to be your end of day profit, the money that you make after everything is said and done. Now, I highly recommend that you become part of the operational expenses. You pay yourself a wage, or you allocate an amount of money to yourself on a regular basis for director fees. In any case, it should be something that you are consistently withdrawing from the business. So one, you're not living hand to mouth. Two, you can give a realistic expectation of what someone else might get from the business when they buy or acquire it from you. You also need to look at your margins on products and services. So if you're not making enough margin, then it's not going to cover the operational costs. The operational costs are going to be there no matter what. And generally those are fixed costs and they don't change. So you need to increase the sales volume and your margin to then make sure that you've got enough left over after everything is said and done. Your margin calculations are probably the most important thing in your business, because if you're selling a product and you're not making money on it, then there is no point being in business. A decent margin, if you're providing a service, for example, you might look at a 50% margin. That means in a $100 product or a $100 service, you are making $50. That's the margin, the 50%. That's the gross profit. So yes, there are multiple terms for the same thing. However, there are different occasions when you would use them. Gross profit is kind of like talking about the end result. Margin is more talking about what percentage are you allocating to become gross profit after you've sold the product. Quite often, businesses can make a significant improvement in their business simply by increasing the prices. When was the last time you increased prices or tried to increase the prices? If you did, how many customers did you lose? Did the number of customers lost equal or greater than the value of increasing the prices? If you increase the prices and lose 1 or 2 customers, is it really going to affect your business? You can afford to lose some customers in order to have a better profitability overall. Remembering that you've got A, B, and C type clients. A type clients love you for you. They know what you do. They like what you do. They are okay to interact with you. So if you have to increase the price, if you're a little bit busy, they understand. If you come up with a new product or service, you can talk with them and get feedback, but they know you, they like you, and they trust you, and they're going to continue working with you. Your B type clients are looking for a better deal, and they'll move if it's good enough, but they're not going to move if it's going to be more convenient for them to stay. So they're not as invested. They might jump if there's a violent price increase, or they might stick around and deal with 1 or 2 problems, but generally they're ready to go, but they do still have some level of loyalty to you. Your C-type clients are probably the worst ones. They're the most difficult to service. They're most likely to jump. They're going to haggle on everything. And if you don't have a better price, they're out the door tomorrow and they are going to go to someone else. So ideally, you want to try and attract as many A and some B. It's unavoidable at times, but ideally, if you could get all A-level clients, then that would be amazing. At this point, it's important to remember the Pareto principle, 80-20. It might seem like you've got less clients and that might be a bit stressful, but you end up with better clients that trust you, that are willing to stick around for the long term, and are more valuable when you service or when you provide services or products to them. Now, using the 80-20 rule, that means that 80% of your value comes from 20% of your customers. So that means you should also be spending more time on the good quality customers. If you go and spend a lot of time and money on people that are not a lot of value, you can't then go and spend that time providing great quality services to the clients who love you and adore you, who are easy to work with and that pay good money and don't complain. So where would you rather spend your efforts? Is it with the ones that take a lot of energy, or with the few that take very little energy, but then you can go above and beyond and provide amazing service and everyone's happy at the end of the day? So as a business owner, in order to remain profitable, you should be working on a few things simultaneously. One, you want to increase your number of customers. I think that's what everybody automatically assumes as being the first go-to response. Next, you want to increase the amount your customers spend with you. Now, you might think that if I get more customers, I'm going to get more money. Not always the case. If we go back to the profit and margin, that energy, that 80-20 rule, it's actually going to be a little bit more frustrating having more customers sometimes. So what you want to do is get clear on who your customer is. Go more A clients, and then once you service them really well, go harder on getting more A clients. The next thing you can do is charge more money. So you've got the same number of customers, but you're charging, 5% more, 10% more. If you've got 100 customers and you charge $100 more, now you've got $10,000 more. So it just depends on what you've got in your product and service mix. However, if you can get the ratio right, then it's going to go really well for you. The next thing you can do is increase the number of times people spend with you. If they're only going to spend with you once and you charge a good amount of money for it, that's great. However, you could even improve that further by having some level of long-term customer value. And that's exactly what we want to increase, the lifetime customer value of that customer. If you can increase the lifetime value by simply adding on an additional service or a product or something like that, you could do it with a subscription. You could have an aftercare service. You could have a recurring product of some kind. Or perhaps if you break the project into stages and have like a stage 1, a stage 2, a stage 3, then that maximizes the value. You have to do the same work to acquire the client in the first instance. But then if you're selling more to them, that marketing cost has only been incurred once. So now you don't have to have 100 marketing costs for 100 clients. If you can have 10 clients spend 10 times more with you, you're going to get the same, if not greater value. On the cost side of the equation, you should be doing as much as possible to minimize costs without destroying the quality of the experience for the customer. So whilst you should be cutting costs, those can be done on things like being efficient in perhaps the way you source your materials, the way you source your staffing, that sort of thing. But in terms of your costs, you can work on your variable costs, which is the thing that it takes to do the actual task. So if you save 30 minutes in labor by creating a more efficient process when delivering that particular service, now you've effectively improved your variable costs. If, however, you create a saving on rent, maybe you negotiate a better term or different payment negotiation terms or something like that, then that is a fixed cost, and that is more in the operational side of your balance sheet or your profit and loss. You might be able to improve costs by negotiating different deals with suppliers, or coming up with a preferred supplier list, or capitalizing on supplier sales. Sometimes when you order a lot of stock from someone, they might have a particular deal going. Or if there's another business liquidating, you might be able to go and buy their stock at a discounted rate. There are a number of ways in which you can create cost savings in your business. And as you start to grow and scale, and you need to delegate tasks off to other people, now you need to be a little bit careful about the way your team spend or manage time, cost, etc. So you can put performance metrics around productivity criteria. You can have standards. For example, in McDonald's, they have a salt dispenser that exactly dispenses just the right amount of salt. 1, for cost control, but 2, for the flavor on the fries. Processes like that start to standardize the way things are delivered. When you go to Domino's, the pizza has X amount of pineapple or X amount of olives, and it's the same every time. If you had a couple of employees that are excessively heavy-handed with the ingredients, then maybe you might churn through 10 or 20% more over the course of a week or a month. And then that could result in a couple hundred or a couple of $1,000s in additional cost. So having procedures really does help with not only the consistency of the product, but making savings on the operational side. Now, I want to stress again that cash is the lifeblood of your business, and this is one of the most important things to manage. Profit is not cash, and cash is not profit. Sometimes you might have a glut of cash because someone made a prepayment, but that doesn't mean you get to go wild with it because you've got other expenses coming up, which might be the wages, etc. So don't go buying a fancy boat or taking a wild holiday when you haven't yet calculated whether or not you can actually use that cash. Sometimes there's shortages of it, in which case you've got to go get loans or financing or something like that. Now, you should avoid going into debt in order to have cash to operate your business. But if you're going through a period of rapid growth, it may be unavoidable. You need to have some controls around this and start to forecast your need for cash. You can do a daily cash flow forecast, in which case you schedule out all of your expenses and all of the things coming up. So you might have regular expenses. You might have planned expenses, like when the day the rent comes out. I know that a couple of major organizations such as Tesla, Walmart, or whatever have been within hours of being completely broke. And that is because they manage cash flow with such tight margins that they are managing it down almost to the hour. So not that you should run your business like that, but if you've got a well-controlled environment, then you have a lot more power, you have a lot more options, you have a lot more flexibility. So the reason why you want to control cash flow is because if you run out of it, you can't pay staff. They leave. Now your business has got a bad reputation. It completely falls out from underneath you. If you've got too much cash, now you need to start looking at, can we invest it? Can we make some money on it? But if you invest it and you make money on it, that it's not locked away so you can't quickly access it if there's an event where you need a lot of cash and you can't otherwise source it very quickly. And understanding what cash we have to play with allows you to understand what other decisions you can make. For example, are you going to invest in another marketing person? Are you going to invest in advertising? you need to know what your budget is and spend within that, not over it. Even if you can see cash flow going downhill, a forecast is going to help you to make a long-term adjustment. You can see that in 3 months, we're going to go into the red. So now we can start doing things like calling up customers to see if they need more things. We can look at different negotiation terms saying, hey, if you pay up front, we'll give you a small discount. You can start to take action today to avoid getting into the red zone in the future. And sometimes by having that advance warning, you can completely avoid what would otherwise be a bad situation. Some businesses have seasonality, and you need to think about that in advance. So it might be based on your geographic location or your type of business. For example, the tour industry has a lot of seasonality. You might have a lot of work on during peak season and then nothing for the rest of the year. So you need to allow for the cash flow to be able to keep the lights on in the time that you don't have that season peak. So getting back to the conversation of margins, I'd like to give you a mantra, and that is never discount, always value add. The moment you compete on price is the moment you start signing your death warrant as a business. You need to start thinking about profit as a right. You are allowed to make a profit. You are allowed to put food on your table. You need to make a profit. And if you don't make a profit, you're not in business, you're a charity. Even charities need to make profit. And instead of using that as a profit, they just redistribute it into certain initiatives. So you need to be making money so that you can afford to continue to provide amazing service for your customer. Don't ever feel that you have to discount your services or rates. If they say they can get it cheaper elsewhere, then use certain sales scripts you can go into in order to evaluate the competing quote with yours. Maybe you could ask them, if it was the same price, who would you choose? And get them choose based on value rather than price. And then try to remind them perhaps there is a way to get the job done within their budget. Maybe you just need to renegotiate the term. We could do it at that price, but we need to remove this, that sort of thing. I once worked with a security company. They had a camera sales business and they would go door to door selling security cameras. So one day they decided they were going to pack up shop, and I spoke with them and they basically said that we're not making any money. We can sell, no problems, but we're not making any money. So I simply said, double your prices tomorrow and see what happens. They went door to door again and they still sold cameras, the exact same product, the exact same approach, and they still managed to sell the exact same number of cameras. So all they did was increase their price. They doubled it. And so I said, well, why don't you double it again? So they doubled it again. And I took them another 11 times of doubling their price. So they were so low that they weren't making any money, but they doubled their price 11 times before they started to see a drop off. And then after that drop off, they just brought it back one. And then they saw that the sales picked up again. So there is a point at which the sales are more efficient at a higher price. And if you increase it too much, you will see a drop off, but sometimes that's not a bad thing. A small drop off with a higher price point actually makes it easier to serve the fewer customers and you become more profitable. You put the price up yet again, then you see too much of a drop off. Now you've gone too far. So you need to strike the right balance between the two. But once you understand your margin and your profitability, and again, going back to that Pareto principle, maybe you can serve half the number of customers and still make the same money. It makes sense to do that because now you have less stress. It's a lot easier to do the job. You can provide a better service to the customers that you do have. And now you have greater capacity to take on more work. So after you've made the sale and you've sent out the invoice, well, now you need to collect the funds. Now, ideally, you want to try and minimize your credit policies. And that means trying to collect money upfront where possible. If you go to a coffee shop, they don't send you an invoice. You generally pay upfront. Sometimes you go to a restaurant and it's a different kind of thing. It's more of a sit-down affair. And generally, it's a restaurant as well. They're not just going to do that for coffee. They need to be high volume, low fuss, low admin. And it's much easier if you just quickly tap and go. So now when you're doing a service, it shouldn't really be any different. There's generally no reason to give someone an invoice unless you already have a trade relationship with them. Or perhaps it's industry standard, but it's still okay to ask for the payment up front because an invoice is just an invitation not to pay. So if someone decides to pay, they might pay in a week, 2 weeks, 3 weeks, 90 days later, 180 days later. And sometimes when working with very large organizations that are very complex, it might be their policy to wait 180 days. and then complain about something on the invoice. So then you have to go back. And by that time, you've spent so long, your notes have disappeared, you've forgotten what it was that you did with the client. It's really hard to justify, and it makes it really easy for them not to pay. So you really need to try to collect those funds as soon as possible. And the more proactive you are about it, the more likely you are to collect. If you are proactive and you start making those calls within your terms on time, then it's going to be a signal that you're not someone to muck around with. If you leave it, they're potentially going to let it drag out and let it drag out. The key is to set the expectation early. There are other things you can do, such as invoice financing. If you need to get some cash flow in the short term, you have the ability to add payment interest, although sometimes that's not enforceable in court. Then if you want, you can look at a credit collection process where an escalation of force, where maybe you make a few calls, then after a certain point, you hand it off to a debt collector. And then after a certain point, you've then got trade credit insurance and things like that. There are credit checking systems that allow you to search the person that is about to become your customer. It just depends on the size, scale, and importance of the deal. Now, sometimes when you're working with certain types of companies, they will have a credit process. In order for you to become a credit customer, you have to create a trade account. And in that process, they go and get director references, get a director's guarantee, they do a credit check on you, and then only then are you allowed to get an invoice for services or products. Otherwise, everything is up front. All too often, I see many small businesses default to 30-day terms, when really in a small business, probably 7 days is really the expectation. But even then, the average payout is probably going to be around 14 days. So it really depends, and about setting those expectations early. However, sometimes as larger businesses, you've got a process. You've got to run that through the systems and processes. It's got to go through a couple of hands before it gets signed off and paid. That's fine too. So sometimes terms do make sense, but maybe you want to just pick and choose who you give those terms to. As the large company making purchases, now you want to start looking at purchase orders. So this is a purchasing process that forces people to go through an authorization process before they actually spend money. If things have to be authorized and they have to go through paperwork in order to get something signed, they're probably not going to do it, which means that you're not going to be spending money, or at least they're going to raise the conversation with you before they bother putting in the application, because they know it's probably going to get rejected. This helps reduce random spending in business and protects the bottom line of the company. As you start to scale as well, it's important to check your supplier quality. Are they providing good quality products and services? Are they a legitimate business? Have they got all their paperwork in hand? Have you got a process agreed should anything go wrong? Now, when it comes to your suppliers, you should periodically go through and review your products and services that you're consuming as a business. If you're consuming a lot of something, you might be able to go back and say, hey, can we get a better deal here? Alternatively, if you've been working with someone for a long time, maybe there's some other way to look at a better negotiation, or maybe do more for a good deal or something like that. But also, over time, other suppliers become less relevant to you. So you might look at going, well, do we really need that expense? Alternatively, you might say, well, we've been using this person for a long time. Can we get a better deal? There are 1,000,001 subscriptions out in the marketplace, and the average household spends about $2,000 a year on unneeded, unwarranted subscription products and services. So yes, subscriptions are a great way to keep your customer locked in, but also try to stay relevant, not only for you to your customer, but you also need to look at the relevance of the subscriptions that you're signing up for to make sure that they're still of value to your business today. So if we think back to the profit and loss calculation that we talked about earlier, every dollar earned is broken down into a number of parts. We've got the base cost of what it is to deliver that service, or the direct costs. So if we're making a coffee, for example, there's the cup, there's the coffee, there's the spoon that you would have used, that you allocated, the lid, the sugar, the napkin, and all of those have a cost. And the total cost might be, say, $2, but the coffee is selling for $4, which means that the margin is 50%. So for every coffee you sell for $4, you are making $2. So that means that if you make more money, to make another $4, you have to sell 2 coffees. Every dollar does not necessarily go to the bottom line, and that $4 now has to pay for operational costs and staff. And if by all of that per coffee, that's another dollar, Now we're only making $1 per coffee. So if we want to make $4, we now have to sell 4 coffees. So you can understand how making more money is not always the answer. If you save money, every dollar that you save goes directly to the bottom line. There's nothing else it needs to pay for. So you need to look at both ends of the equation. Yes, make money, but also saving money. And those powers combined make your business much more efficient from a financial perspective. Another thing you can do is look at a product pricing ascension model, which is effectively a range of products at different price points to suit different people in different points of the market. Again, in the coffee shop example, when you go in, they've got a small coffee, a medium coffee, and a large coffee. Now, they're all slightly different price points, and the sizing is not that different from each other. But you might go in there one day and go, I don't really feel like much, I'll just grab a small. Another day you go, I'm absolutely craving a big coffee, and you pick the large. And on average, most people pick the middle one. We often see with a lot of pricing around services, sometimes bigger businesses that come along and buy services from smaller business look at them and go, well, is that it? Because all of the products are aimed at a much smaller market. So, you know what? Add that $50,000 product. It may sell. If you don't have it, it's not going to sell. But if you add that $50,000 product, now that brings everything else up in the range of prestige and value. So your lower end products look more important and look better value. And your high end product, well, if you sell one, then you're going to have a pretty good payday. One of the other ways we mentioned of being more effective is your ability to increase your throughput or increase the volume of transactions that you can deal with. Ideally, digitally optimized businesses grow 5 times faster, and you can do a lot more with the same team. So you can grow your services volume and capacity without necessarily increasing headcount. So the more that you systemize and optimize the business, then the much more throughput you can have. And that means the more money, profitability, etc., from the same cost base. So if you work in a project business, one of the big killers of productivity is work in progress. And that just means that you've got a lot of projects that are partway through or half done, and they're all clogging up the system in the sense that many people have to remember many different clients and many different projects. And so their bandwidth to be able to take on new projects is diminished. So by reducing your work in progress time, i.e. shortening how long it takes to do a project, you can actually fit more projects in. So sometimes that extra cost, like a project manager, might actually significantly improve your throughput, which then increases your revenue, offsets the cost of the project manager, and everything works together well. And it makes for a happier client because their project is delivered faster. One of the next most important things that you need to do is figure out what your break even is. That is the number of dollars that you need to cover your costs from your gross profit. So if I'm making a $4 coffee and my margin is $2 and costs me $50,000 a month to run the operation, I then take the $50,000 and divide it by the $2. So if my operationals are $50,000 a month and I'm selling coffees for $4 and they each make $2 per unit, I then take that $2 per unit gross profit and apply it to my operationals. So my $50,000 divided by 2 means that I have to sell 25,000 coffees per month in order to make my operational costs or to break even. That is 833 coffees per day. Yes, these are real numbers. No, that is not unrealistic because the systems and the processes have been set up in such a way to make that efficient. But continuing this example, if I increase the sale price of the coffee to $5, now making $3 gross profit, I then apply that to my $50,000 operational cost. I now only need to make 16,666 coffees per month, which equates to 555 coffees. That's roughly 300 less coffees per day that I have to make in order to break even in the business. So you can see how dramatic of an impact increasing your prices can have. Now, we need to take a number of factors into consideration. Actually, the gross profit on coffee is a lot higher. However, food sales, generally the gross profit is a lot lower. and you need a good product mix in order to get the average gross profit to cover the operational costs. Having said all of that, it's a little bit more of a complex calculation, but these are examples only. So from here, make sure you calculate your margins, have a look at increasing your prices, reducing your terms, and fixing any of the revenue leaks and holes in your business. Go and look at your costs and see what you can cut. We're going to go into more detail and a couple of other things in future modules. Don't forget to keep writing things down, keep implementing them, and watch out for the next course.